What is your assessment of the PMI data that we got? Non-manufacturing expanded beyond the forecast, manufacturing a little bit below the forecast, but still in expansionary territory. Then we had the Caixin survey as well. Are we going to get the sustained strength in May, do you think, or is that external demand picture going to drag?
Well, certainly the external demand picture will certainly be a drag. But I think my readings of the latest PMI reading, I think on the manufacturing side, I don't think that's really a big surprise, not a big deviation. I think where there's a little bit of optimism is in non-manufacturing activity. There was always a lot of questions to what extent the services sector and some of the activity related to consumer choice and behavioral shifts will change as people feel a little bit more confident about the virus. And it's encouraging to see that we've seen a little bit more improvement there, much more beyond what were expected. So I think the hope is, at least going into the month of April, at least China seems to have contained the second wave, that if they can build on that going into the subsequent month, that would be positive. Having said that, when you look at the Caixin PMI, it kind of tells you really the lingering pressure among the small businesses. So one of the key things I think the market will look out is that although external demand is still very, very challenging in 2Q, I mean, clearly U.S. things are still going to get worse in second quarter. Now that China has an NPC meeting scheduled on May 22nd, we're hoping there will be a little bit more policy support coming into the market, coming into China's economy from the government.
Yeah, that's key, isn't it? We're going to get that growth target possibly at the NPC. But PBOC Governor Yi Gang, he's made a very strong point of saying we're not going to get aggressive stimulus. Are we setting ourselves up for the markets to be disappointed if we don't get additional steps from policymakers like Yi Gang?
Well, there's always going to have to be some little bit of a management of expectation. I mean, obviously, if you compare China now to where we were prior to the global financial crisis, you know, I think the buildup of leverage, the concerns about kind of the fiscal policy space, I think that will continue to be somewhat of a constraining factor in terms of the size of the stimulus that they can do. But having said that, I still think they can do a lot more than what they have so far, and clarity on that in the run-up to the NPC will certainly be very positive. Plus the fact that I think globally, you know, earlier there was a bit of concern about inflation in China, but pretty much now I think that inflation concern has really dissipated and gone into the back burner. And the bigger source really is the worry about the demand shock and the lasting impact that has. So I still think that we're going to see something. I mean, our estimate is fiscal, quasi-fiscal in the order of about 5% of GDP, which again is not as huge as it was post the global financial crisis, but it's certainly bigger than what we had in the previous years. And that hopefully will enable some confidence to be bolstered.
And Johanna, we've been seeing globally when it comes to stimulus, it seems like it's mostly been targeted towards keeping jobs, also when it comes to keeping businesses afloat. What can governments actually do to actually stoke that kind of consumer spending, as you've been saying? How do you get people to spend again?
Well, first of all, you got to contain the virus. That's number one, right? If you don't contain the virus, then really you can't expect people to go out and, you know, socially engage. So I really think governments have to do all they can to first do whatever health expenditure, intervention, mitigation tools they can use, and then at the same time not only provide kind of support, you know, again, social safety nets and insurance, social insurance, but also provide some amount of bridge financing for business and households, so that when we get out of this pandemic shock, that, you know, the lasting damage can be mitigated and we could have a little bit more of a recovery. The challenge at the moment is actually when you look across Asia or even, you know, the rest of the whole world, really we find that it's the more developed markets, the richer economies to begin with that have more fiscal space or more financing and policy tools at their disposal that are announcing a more broader sweep of policy intervention, whether it's, you know, job support, unemployment insurance, you know, cash handouts, health expenditure, but also some amount of quasi-fiscal or guaranteed kind of bridge financing. But when you come to the sort of the lower income developing economies, what we find is that the fiscal constraints are much more acute. So when you look at the fiscal package, they can really only spend on health, immediate needs on health or in cash handouts, but we're lacking kind of fiscal, quasi-fiscal support on the individual household and the business sector, which is why you'll have solvency issues in some of the economies where the government's not stepping in. And that obviously creates another host of other problems that may come out that will outlast this pandemic crisis.
And what you're seeing now is EM central banks, at least some of them, are starting to buy bonds, and Indonesia certainly is a prime example of that. Does this just open a whole layer of risk here of where these economies have fragile currencies and could actually stoke some inflation right now and really spark some capital flight as well?
So where we are at the moment is certainly we're providing avenues for kind of new mechanisms or tools for monetary policy, and some of these tools are consistent with central bank mandates of maintaining financial stability. That you have to kind of intervene, and because as central banks have potency of policy tools are constrained by the zero bound, they start going in this uncharted territory. But you're right, it does raise some concerns about the relationship between the government and the central bank, because some of the objectives of central bank policy for financial stability is indistinguishable from objectives related to government debt management. So these are things we need to watch. Now, having said that, they're opening up the tools. The question is how it's actually used in operation is something that we need to still see. And I guess the longer this crisis drags out, the worry is that the burden on the fiscal side will grow and grow. And in order to kind of maintain or kind of manage the fiscal implications and the debt implications of that, more and more central banks will go down this route. And it's not just Indonesia. We've had Philippines introduce new tools. Possibly we will also have it in India. So, there's a number that will do that. Now, the question is, will it have unintended impact on capital flow volatility, on currency? Yes, certainly. That's certainly one of the things that distinguishes developed countries and developing countries in terms of flexibility. But, in Asia, we have a number of countries in Asia that are less concerned about FX implications. The likes of Korea and Thailand, I don't think it's as big of an issue, but it may be more of a constraining factor for some of the more developing economies that rely on external commercial borrowing. And I think on inflation, we don't have to worry really at the moment, because the size of the demand destruction is so large that obviously that's not a concern at the moment. But I guess in the medium longer term, what happens if the economy recovers and the cycle reverses? How do you exit from unconventional monetary policies? It's something that we haven't been there, we haven't tested yet. But again, maybe at the moment it's a bit early to worry about that.